Let's talk about what's actually happening in 2026. The S&P 500 is sitting near all-time highs, but there are real headwinds underneath the surface. The Iran conflict has pushed energy prices up. Trump is saying one thing, Iran is saying the exact opposite, and under the hood, behind all the talking points, shipping costs are elevated, inflation is sticky, and crude oil is making itself felt at pumps around the world. Some countries are worse off than others. The U.S. has some insulation from the Strait of Hormuz disruption, but other nations are in full code red on energy, urging citizens to dial back consumption. When energy costs spike like that, inflation doesn't ask for permission. And here's what makes this geopolitically interesting. Iran knows exactly what inflation does to markets. So, the question a lot of active investors are sitting with right now is, how far does the Trump administration push before something major breaks? The market's current read seems to be that a peace deal, or at least a significant de-escalation, is more likely than not. And if that happens, this market goes much higher. The good news for bulls? The market is becoming increasingly resilient to negative war headlines. That's actually a constructive signal. U.S. Bank's investment strategy team noted that corrections now follow expectations about future economic conditions, not just headlines. And the real risk is whether sustained energy costs start feeding into inflation and force a repricing of growth expectations. Now, Warren Buffett. Berkshire Hathaway is sitting on record cash. In a recent interview, Buffett said 2026's market wobbles are, quote, nothing, and that he's waiting for real fear to generate real opportunity before deploying a single dollar. He even said nothing looked on sale to him, even after the recent pullback. Look, the man is a cheap date, but he's also one of the greatest investors who has ever lived. And when Buffett holds cash, that is not a bearish signal. That is a disciplined signal. There's a difference. So what does all of this mean for active investors right now? First, know what kind of dip you're actually in. There is a massive difference between a sentiment-driven pullback, a valuation correction, and a structural bear market. The April 2025 sell-off was sentiment and tariff-driven, sharp, fast, and fully recovered. That is a completely different animal from a recession-driven decline where earnings are actually contracting. Right now, estimated S&P 500 earnings growth for 2026 is tracking above 20%. That is not the picture of a structural breakdown. Keep that in your back pocket when the headlines get loud. Second, be brutally honest about your positioning. Dips expose over-leveraged and over-concentrated portfolios fast. If a 10% drawdown has you checking your account every hour, that is useful information. Your actual risk tolerance and your stated risk tolerance are not the same thing. Near market tops, it is not a bad idea to be sitting on around 20% cash. Reduce margin. Avoid options plays near highs. Build your dry powder. Because when the market finally puts your favorite names on sale, and it will, you want the cash ready to buy a significant position, not scramble for liquidity. Use the dip as a portfolio audit, not just a buying signal. Third, if you're buying, buy quality. Make your list, check it twice. Know exactly which names you want and why you want them. Because of the company, not because the chart looks like it might bounce. That second one is called hope, and hope is not a strategy. U.S. Bank's strategy team has flagged an up-in-quality bias for 2026, prioritizing profitability, balance sheet strength, and reasonable valuations. Buying beaten-down stocks with weak fundamentals just because they look cheap is one of the most common and costly dip-buying mistakes active investors make. Not every stock that drops recovers. Know the difference before you pull the trigger. Fourth, respect dollar-cost averaging even as an active investor. If you're managing a lump sum or a windfall, spreading your entries over 3 to 4 months during a volatile period dramatically reduces the risk of catching a falling knife. A phrase that gets used a lot in this industry: missing one dip won't hurt you, but making an emotional decision might. If inflation data starts cooling, rate cut expectations could fuel the next leg of this bull run. Keep tabs on oil prices, the VIX for your volatility pulse check, and news flow out of Iran. Right now, semiconductors are the sector getting attention, but this market shifts focus fast, and where we're looking in a month from now could be completely different. Stay nimble. If you're tracking a specific sector through this volatility, drop it in the comments. I'll cover it in an upcoming video. Please like and subscribe. Thanks.